Welcome back, and now for some fundamental cues. Girish Pai, Head of Research at Nirmal Institutional Equities, joins us. Good morning, Girish. Thanks much for joining. Well, does it look like a bottom is in place? Are you a buyer as the index moves towards 10,100?
So from a risk-reward perspective, I think it's kind of evenly balanced as things stand currently. I think we could probably see a 5 to 6% upside and possibly even a downside. So I think until the financials, which is a very large weight in the index, are out of the woods from a news flow perspective, I think the market should not probably see fresh highs. I think concerns regarding inflation, though I think it's been partly allayed by what we've seen from the RBI recently, though I would think the market is still concerned about inflation, especially in connection with what could potentially happen on the MSP side and possibly crude, and also possibly higher consumption-related spending that the government could inject into the economy as we come towards election. So I think there is definitely an inflation-related issue that we're facing, which will probably come to the fore towards the second half of the calendar year. Plus, there is an asset quality-related problem which we don't have a handle over as things stand currently. We don't know what exactly the provisioning number is going to be like for fourth quarter, especially for corporate banks, and how that's going to pan out into first half of next year. Once we have a handle over these couple of, I think, macro points, I would probably think the financials will be ready to rally, and that's when I potentially see the market actually going up. From where the market is vis-a-vis maturity of the bull market, if you look at one-day cricket parlance, I think probably when the 40th over of a 50-over match. So we still think there is for some bit more for this market to run, but we're probably there. I mean, probably we're 80% through. Is broadly our view on where we are from a maturity of the bull market perspective.
Girish, it's interesting, we came into Q4 with the broad expectation that this is going to be the defining quarter. We'll finally start seeing good numbers. Interesting headlines, and all the papers today point out that it could be a far more sort of, measured approach, so to speak. What's your expectation from the earnings?
Yeah, so I think if you take out pockets of the market, I think they will still be fairly decent earnings coming through. If you look at, say, private sector banks and private NBFCs, if you look at the consumer sector, if you look at autos, I think these are areas, these are pockets of the market where we think the demand is fairly robust and earnings picture looks fairly good. But I think there are other parts of the market which kind of would weigh down on earnings in 4Q and probably even in the first half of FY19. And these have to do more with the corporate banks and the asset quality issue and the provisioning situation that I talked about. I think that is a fairly uncertain number, and I think people are putting in various sorts of numbers. So that is a part of the market which will kind of push down the aggregate numbers, the index levels. So while we started the year with probably like high teens kind of a number from an index earnings growth perspective, by the time the year ends, my sense is we'll probably be mid to high single-digit index level earnings growth, which means that the next year's earnings will start looking, earnings growth is going to look far more robust than it should normally look like. So my sense is that the number is probably going to look between 25 to 30% index earnings optical, in the sense that we've seen a compression in FY18 earnings, and with FY19 earnings broadly remaining constant, you will see this optical up move of earnings growth picture.
Okay, Girish, good morning. Of course, that's for corporate banks, but what about large cap IT? We'll have Infosys this time actually in Friday evening, I think. And the stock was a bit soft, of course, on Friday. So, what are you building in for large cap IT?
Yeah, so if you look at the aggregate numbers for large cap IT, we kind of think that earnings will be flat to maybe marginally down on a year-on-year basis. We probably think that's probably going to be the case even for Infosys this particular quarter. On a quarter-on-quarter basis, we are kind of building in about 1.5% kind of constant currency growth for the tier one set of IT services companies. I think the key thing to watch out for is the guidance they're going to give for FY19, where we think that the company is probably going to give a guidance of 5 to 7%, which is, I think, at least 200 basis points lower than where the consensus is from, where the consensus thinks the guidance is going to be like. Our concerns largely stem from the fact that we have a situation where the total contract value added over the last 12 months, ending December 2017, has been 25% lower than what it was the previous year, calendar year that is. And in terms of new deal wins, my sense is it's down about 40 to 60% under various scenarios that I've kind of built. So I think the guidance is probably going to be fairly soft. And that could potentially disappoint the street from a growth perspective, and which could lead to some pressure on Infosys. I think what happens beyond first half, I think, is something to be looked at. It all depends on what kind of scenario builds up post Mr. Salil Parekh coming in, and what he's able to deliver going forward.
Okay, well, actually on that issue, Girish, not just Infosys, generally, is the IT pack something that you would chase at current prices from an earnings angle? What are you expecting?
So we changed our stance recently from being negative on the sector for almost 3 years to being tactically bullish. And the tactical bullishness comes more from a technical view standpoint rather than any fundamental change in opinion. So we changed our view largely because the sector has been underweight in institutional portfolios for a fair bit of time, and there is a modest uptick in earnings growth that one is expecting in FY19. I don't think that's going to continue into FY20. So we do expect some bit of revenue kicker coming in because of better US economy and better spending by corporates because of US tax reform related benefits. But looking out into FY20 and beyond, we think that growth is again going to come off. So we are not building a situation where this is a structural buy. We still think that earnings growth for the sector is going to be mid-single digit kind of a number, assuming that rupee doesn't depreciate very dramatically from where it is right now. So in such a scenario, we think it's at best a tactical buy at this point now, because the financials are under pressure. The very large weight in the sector is under pressure, and I think it'll continue to be so for the next 5 to 6 months. I kind of laid out the reasons why that particular sector is going to be under pressure. So it's more of a relative call. So we think that, yes, it's more of a trading bet, so to speak, right now, but not a structural buy.
Okay, it's really interesting you say that, Girish. You've tracked the sector for many, many years. Where does it leave some of the mid-cap IT high flyers? They've been the best performing stocks in this market volatility, the likes of Hexaware, NIIT Tech, etc. Is there a structural story there? Any mid-cap picks that you'd go with?
No, again, I'm a contrarian there. I don't believe in this the faster growth for longer kind of theme that some of my competitors are kind of painting for mid-cap IT companies. I think the faster growth is going to be there for maybe 1 or 2 years at the max. I think the mid-cap companies have vulnerabilities. Their business metrics are fairly, I would say, risky in one sense, because the client concentration is anywhere between 45 to 60% for top 10 clients. And we've seen some of these companies actually deliver negative surprises from a growth standpoint even in the recent past. For instance, say Persistent, for instance, came out and said that the IP revenues are going to decline fairly substantially in 4Q versus 3Q. So there could be surprises which are not factored into current valuations at this point in time. Street is building in a very strong growth sustaining over the next 2 to 3 year time frame. I doubt whether that kind of scenario is going to play out, because I don't think the business models are very differentiated versus the tier 1 companies. So I'm not betting my money on the mid-tier companies at these valuations. I think probably 6 months back they probably made sense, but not right now.
Okay. Well, Girish, we'll have to leave it at that. Thank you very much for joining us, and have a great trading week ahead. The first of your important companies will announce numbers before the week is out. I'm a little troubled when companies announce results or any announcement on a Friday evening. Which means, the first numbers may not look good, but please look at the fine print.
Exactly.
It seems to look like that.
And on Friday, the stock was down. And it's a 2-day board meeting. You thought that it will start on Thursday, and normally you would have thought that, okay, Thursday it will start, and Friday morning they'll announce the number. It's Friday 4:30. So.
Okay. Well, there could be other strategies, but it's just a bad feeling when announcements come on Friday night, and planned to come on Friday night. With that, let's get you some F&O cues. Chandan Taparia of Motilal Oswal has joined us. Good morning, Chandan. What do you have for us?
Very good morning. Again, stock specific action is likely to be there. Market has seen recovery of around 350 points from lower levels, and now 10,222 is likely to act as a support to extend the rally to a 10,440 kind of zone.